Good evening, ladies and gentlemen, and welcome to our class on how to trade economics data. And tonight's class is sponsored by or brought to you by investing.com, and we're going to be discussing news and different types of fundamental analysis. Now, trading the news can be very profitable if you can correctly guess which way price is going to move. Price can often move 30 or 40 pips very quickly on big news releases, but knowing which way it's going to move is very important and a very big gamble. So most traders do not trade the news. It is just too risky, and you often get stopped out as price moves one way and then the other. Most traders have experienced this whipsaw effect when price goes up and then goes down very quickly. So it seems no matter which way you trade, you can always get stopped out when there is huge market volatility. But you can also capitalize on market volatility to make profit. When an economic release comes out, markets can react violently as traders enter and exit positions based on the new information. Some news releases are more important than others, like the non-farm payroll report, which will be released this month, I believe, on the 10th. CPI, inflation data, and central bank announcements typically move the needle more than most, and these events see the sharpest price spikes. There is good reason for this. Central bank announcements, like rate hikes, directly affect money flow, which has a major bearing on the economy, while inflation figures or unemployment numbers can influence central bank policy. These days, sophisticated algorithms are able to process news releases in a blink of an eye and move the market accordingly. Financial markets therefore adjust quickly to the new information. Even so, the biggest news releases create opportunities in the market because they can cause long-lasting price moves and momentarily distort the efficiencies of the market. Now, the economics calendar is a fundamental analysis tool for traders to position themselves to take advantage of currency movements. The economics calendar, which is published daily, is the main trading tool for traders that use fundamental analysis as signals for entering and exiting trades. Economic and political news can change the direction of a currency pair in seconds, and fundamentals that are true in one instance can be rendered absolutely meaningless by fresh fundamentals a second later. The economics calendar enables traders to keep track of economic indicators and political events that impact currency movements, commodities movements, CFD trades, just about every tradable instrument in the market. Now, believe it or not, there are a large number of amateur traders who ignore news events and economic releases completely. They concentrate solely on technical indicators and chart patterns. Then they wonder why the market spiked violently against them in the space of a couple minutes. Other traders acknowledge the importance of news releases, but they see them as unpredictable and too risky to trade. For the most part, they have been taught to trade during quiet markets and to always be flat whenever the news releases are coming out. In truth, there's nothing wrong with this approach. News releases are certainly unpredictable, and they can turn your winning trades into losers if you're not careful. However, I have always been taught to study the fundamentals and the news releases, and news releases offer good trading opportunities so long as you are selective and disciplined in your approach. In fact, some of my best trading wins have come from reacting quickly to big economic releases such as the U.S. payrolls data and Fed Reserve rate hikes. And I have previously spoken of the importance of buying the rumor and selling the fact. In effect, anticipating the news release before it comes out. In my view, news events can offer low-risk trade setups so long as you're aware of the three things: the market expectation running up to the event, the likely reaction from the different outcomes, and the best way to play those outcomes. And we call this building a trading matrix, where you will build market neutral, market positive, and market negative. So when economics data tends to be one of the most important catalysts for short-term movement in any market. But this is particularly true in the currency market, which responds not only to U.S. economic news, but also to news from around the world. With at least 8 major currencies available for trading at most currency brokers and more than 17 derivatives of them, there is always some piece of economic data slated for release that traders can use to inform the positions they take. Generally, no less than 7 pieces of data are released daily from the 8 major currencies or countries that are most closely followed. So for those who choose to trade the news, there are plenty of opportunities. But the most important part is picking your opportunities. Trading news is harder than it may sound. Not only is the reported consensus figure important, but so are the whisper numbers and the revisions. Also, some releases are more important than others. This can be measured in terms of both the significance of the country releasing the data and the importance of the release in relationship to the pieces of data being released at the same time. Now, first off, markets move a lot more in line with what the expectations are for the upcoming economic news release rather than what the actual news release implies. Meaning, because traders trade their beliefs about upcoming economic events, often when the actual event or news release happens, the move is either over or ready to come roaring back in the opposite direction than the actual news report implied. So this is why you may have heard the term buy the rumor, sell the fact. Now, the results from an event can last 1 or 2 days, but in most cases, they are wiped out in a very short term because the markets will get past their violent movements and their knee-jerk reaction, and they might find a new trading level, or they might just return to their previous trading level, or there can be a contradicting result a few hours later. Like you're trading the euro against the pound, and data comes out in the Eurozone that's very strong, you could see the euro surge and the pound just stays where it is. But an hour later, something comes out in the UK that's very positive for the UK, which then surges the pound, and the euro GBP ends up right back where it was trading earlier in the day. So it's important to be aware of all the events and all the news that's scheduled on the calendar. Now, there are many factors that affect these events. We have inflation, interest rates, public debt, political stability, and economic performance, terms of trade, and current account deficit. All of this data is released. Now, sometimes it's called something different based on the country, but all of this data is released month after month by just about every major country. The dates are different, the times are different, how they calculate the results are different sometimes, and what they call these reports are different. But they do, and after a while, you'll know exactly what they are. Like in the U.S., we call our major monthly jobs report the non-farm payroll report. In Australia, we just call it the jobs report, and the UK is called the claimant count report. But it's all the same report, same type of reports reporting the unemployment rate and how many jobs were created. Now, inflation rates are one of the most important data events. Changes in market inflation cause changes in currency rates. A country with a lower inflation rate than another will see an appreciation in the value of its currency. The price of goods and services increase at a slower rate where the inflation is low. A country with a consistently lower inflation rate exhibits a rising currency value, while the current country with a higher inflation rate typically sees depreciation in its currency and is usually accompanied by higher interest rates. Now, in a normal economic cycle, this holds very true. As you know, we're all coming off of this financial crisis where most of the countries went into deflation, interest rates were dropping, we had lots of quantitative easing, and we see that central banks are trying to push inflation up to 2%. 2% is the global benchmark. And you have to understand what each one of these reports is about. Now, 2% is just a benchmark. Okay, we want to see inflation steady because without inflation, you won't get wage increase. Without wage increase, you won't get a surge in consumer confidence. Without better consumer confidence, you won't get a surge in upsell in retail sales. Without an up move in retail sales, you're not going to get increased manufacturing. But once all of this is steady during a good economic cycle, if inflation starts to go up, it starts to weigh on the currency. So imagine you live in Australia and your closest neighbor is in New Zealand. Okay. You have 400 Australian dollars and I have 400 New Zealand dollars. When we go to the grocery store, I used to be able to buy my entire month's groceries for my 400 New Zealand dollars. And in Australia, I could buy my 400, my entire month's groceries for my entire family for the 400 dollars. Now, ladies and gentlemen, I appreciate the fact you all want to ask questions and keep typing them in. Please don't. Okay, all of you are typing in redundant questions, and if you let me move forward and let me finish the class, maybe you'll have a question then. But you're already in questions that will be covered in the class. So give me a chance to go through this stuff before you ask questions that I haven't even gotten to yet. Now, when inflation goes up in your country, and now your same 400 New Zealand dollars you go to the grocery store, you buy the same thing next month, but because prices went up, you need 410 New Zealand dollars. Where in Australia, inflation stayed steady, and inflation is basically how much the cost of goods have increased. And in Australia, you're still able to buy the same $400 worth of groceries. So whose currency is worth more or less? Well, the New Zealand currency is worth less because you can't buy as much. So because the central bank needs to keep their currency steady, most central banks mandates, like the U.S. Federal Reserve, only has two mandates: full employment and steady inflation. They can adjust inflation rates by either lowering or raising the interest rate. Because if inflation is going up and they lower the interest rate, people can borrow money less, so it offsets the raise in the costs. But none of this is as simple as it is. You have to spend some time learning the interrelationships between all of these. In a 1-hour class where we talk about these for 5 minutes each, you're not going to master them. So you have to go back and spend some time getting a good solid grasp. Now, changes in interest rate affect currency values and dollar exchange rates. Forex rates, interest rates, and inflation are all correlated. Increases in interest rates cause a country's currency to appreciate because higher interest rates provides higher rates to lenders, thereby attracting more foreign capital, which causes a rise in the exchange rate. Now, we all talk recently, and all the headlines have been talking about Apple's billions and billions and billions of dollars in cash sitting in banks. Well, don't you think they move their money around to wherever the banks are paying the highest interest rate? Because even though it's sitting for just a day, overnight, 2 days, 3 days, okay, when you're sitting with $100 billion and you're getting 5 or 10 higher basis points than you would in a different country, guess what? That's a lot of money. So when people are shifting money around, again, let's go back to the Australia-New Zealand scenario. And those are just because they're cousin countries. If New Zealand raises its interest rate and is paying a higher rate of return than Australia, where would you move your money to? Well, if I had $100,000 in my retirement account in Australia, and Australian banks were paying 2%, and the New Zealand banks were paying 3%, and the currencies were both overall pretty stable and had a rate against each other that was pretty stable, but I'm not looking to take my money out. I'm looking to put my money in and let it sit there till my retirement. I'm going to put it where I can get 3%, where it's just as safe. You know, a lot of it has to do with safety, countries, laws, regulations, but big corporations and big business deals make a big difference. Now, a country's current account reflects balance of trade or earnings on foreign investment. It consists of a total number of transactions, including its exports, imports, debt, and etc. A deficit in current account due to spending more of its currency on importing goods than it is earning through the sale of exports causes depreciation. The balance of payments fluctuates exchange rates for its domestic currency. Now, we were watching when the Japanese yen weakened, when the Bank of Japan dumped all their quantitative easing and cut their rates back to negative. One of the biggest ideas is not to create a trade war, and they're supposed to not go into currency manipulation, but it drops their value of the currency. Well, for an exporter in a country who's primarily doing exports, that's very, very important, because now they can sell their whatever car they're producing in Japan, a Toyota, a Nissan, cheaper than the Hyundais coming out of Korea, because the exchange rate is lower. So all of this is tied back together. But what happens is when they're importing more than they're exporting, that's not such a good thing either. And so these reports are constantly looking at not just their balance of trade or their current account. They're looking to see if both imports and exports are rising, or one going in the opposite direction than the other. And it has an effect on the currency. And also government debt. Government debt is public debt or national debt owed by the central government. A country with government debt is less likely to acquire foreign capital, leading to inflation. Foreign investors will sell their bonds in the open market if the market predicts government debt within a certain country. As a result, a decrease in the value of its exchange rate will follow. Now, for instance, a lot of countries like Greece have been locked out of the bond market. And so they have a problem. They have a huge government debt, but they need the cash from selling their government bonds to operate their country. But because their credit rating is so poor, nobody's buying up their garbage bonds. Now, when you see Standard & Poor's or Moody's dropping a country's rating system, or you see like the ECB doing huge quantitative easing, what they're doing is they're buying up government bonds from all the governments. So this is helping those governments raise the capital they need. So it's very important to understand how all of this works together, because the central banks can only buy up so much debt before their balance sheets are so out of whack. Now, the U.S. has a huge, huge debt, okay, the biggest in the world. But because it is a locomotive, and even during a bad economic cycle, it is producing goods and services and selling them around the globe, that we do worry about the debt of the U.S., but on the whole, it doesn't affect their currency rate so much. Whereas when we're looking at Japan, we're looking at Greece, we're looking at Korea, we're looking at India, Singapore, we're looking at, the countries that make up the Eurozone. Okay. All of this has a very negative or positive effect on the currency rate. And even though when we get these economic releases, if they're better or worse than expected, you're going to get the volatility in the markets. But once that volatility is eased out, you need to know where that currency is going to establish this new range. So was this term of sale, or was this current account, or was this inflation report overall good? Now, the volatility only comes out if it's better or worse than the forecast. But if it comes out the forecast, it doesn't necessarily create volatility, but it can raise the value of the currency in a slow, steady move. Now, I tell this as a story of your kids and their report cards, because all of these economic reports are basically reports or report cards on the economic condition of a country, which therefore has a big effect on the currency balance. So let's tell you the story. You have a kid, he's a son. He's a good kid. He's in middle school, and he's dependable, reliable, he's honest. You have a good relationship with your kid. Now, you sit down to Sunday dinner, and you say to him, well, kiddo, report cards are due on Wednesday. He says, yup, I know. He says, well, remember last quarter I brought you home 5 C's and 3 C pluses. They said, yup, we know. Then you do the normal thing of a parent's lecture. That's not good enough to get you in university. You got to stop playing on Facebook so much and start playing so much soccer. Start studying a little bit more. He says, yeah, I know. Now, the fact is, you didn't go back to school and do any detailed research. You didn't talk to all of his teachers. You didn't find out from the school board whether they changed the tests or the grading system, whatever else. You just went by the report card that he brought in. And this is called, on the economics calendar, the previous. It's what the data was at the previous release. And these releases that come out are statistical. They are not analysis tools that are being analyzed to give you some type of overall rating of the economy. What you're getting when this data is released is the hardcore factual numbers. So once you're getting factual information, you can then make your own analysis, because it's not somebody giving a study and saying, oh, we think overall inflation is getting better based on this basis. No, they're just reporting what the inflation rate was. They're just reporting how many jobs were created. Okay. So when you know that you're getting hardcore data facts and not some spin, you can work with this. Now, he says, well, Mom and Dad, I think this coming semester, or this report card I'm going to bring on Wednesday, is going to be a little bit better than it was last semester. He says, I did a little bit better on my midterms. I did a little bit better on my homework. I participated a little bit more in class. My teachers seem to be happy. So I think I'm going to bring you home all C pluses. Well, in the scope of things, this isn't bad. Again, there's no analysis. You haven't gone back and talked to his teachers. You haven't found out maybe the teachers are making an upward curve because they need to get a higher rating for the school. None of this stuff. This is just numbers. Now, it is not adjusted, revised based on the current economic situation. It's not looked at as part of how the economic crisis is affecting the globe. It's not looked at in comparison to unemployment 3 months ago, or how the unemployment in the U.S. is compared to the unemployment in China. This is only data. So this is called the expectation or the forecast. Okay? It comes out shortly before the actual event. Now, what happens when your kid told you he was going to bring you home all C pluses? You were pretty happy. You weren't ecstatic. You'd like him to bring you home all A's. But he was doing better than he did last semester, and he's doing higher or better than the overall average. Okay. Now, that's a pretty good thing. So you've adjusted your expectations for Wednesday's event based on the forecast. Now, Wednesday, your kid comes in from school, hands you the envelope with the report card, goes out the back door to play soccer. You open up the report card, and it's all B's. You're astonished. You're shocked. You don't know why, but you don't really care why. You just care it was better than you expected. And what do you have? You have an immediate reaction. You holler out the back door, hey, kiddo, I'm going to take you to McDonald's for dinner, and then after that, we're going to go over to the sporting goods store. You can buy that ball you've been looking at. I mean, you're just thrilled to death. And this is what happens in the markets when data is released. Now, if he would have brought you home all C's and you were expecting all C, or he brought you home 5 C's and 3 C pluses like he did last semester, it isn't bad, but it was less than you expected, so you would have been disappointed. And again, this is how the markets react. And it's the reaction between the forecast or expectation and the actual that causes the market volatility. Now, after the volatility, and after you've had time to digest this, if you do have time to digest it all, you called your husband at work and said, hey, guess what? The kid brought us home all B's. Everybody's happy. Everything's good. Now, in the markets, because nothing stays good forever, you getting ready, you're putting what you're going to cook for dinner back in the fridge, and all of a sudden, the soccer ball comes through the back picture window, shatters the glass all over your living room, and now you're pissed. So you holler out the back door, hey, kid, get in here and clean up the mess. We're not going to McDonald's. You're not getting the ball. You no longer care that his report card was better than expected. You're now upset because you got to clean up the glass, call the handyman, get the window boarded up, and then call a window person tomorrow and get it replaced. And this is, again, what happens in the markets. Okay. Something else happens thereafter that will totally wipe out the effect of this move, or just in the reverse, totally send it farther. Now, this is on Wednesday. By Friday, when you're sitting down with the girls at the girls club, or whatever you want to call it, the PTA, you're bragging about your kid because you forgot about the report card, so to speak. You forgot about McDonald's. You forgot about the broken window, and you're just telling everybody your kid got all C pluses, better than or all B's, and you're happy. And so what happens is you now have a new level. You're not as static as like you were when he handed you the report card, but you're a new level. And this is exactly what happens in the markets. So to be successful, though, in trading this, you have to figure out what's we call market neutral, market negative, and market positive. These are ranges around what the data is expected to be, to ranges that will be positive enough to send the asset climbing, or weak enough that it will send the asset falling. And there can only be projections because the reports are fairly complicated. And there are many ways to trade the results. A lot of people that want to wait for the volatility to go beyond them will wait for 17 hours, 24 hours, and then they will trade an asset to stay higher. Or they'll get in the market before the event release and ignore all the volatility and get out of the market afterwards when the assets claimed a new level. Or they'll just sell when the market bumps up at the new volatility. The thing about all this is you have to be able to cover the swings of the marketplace with your stop losses. And that's very important because the markets get volatile and you can get stopped out and end up with a loss even though you were completely right. So you have to determine where you would expect the knee-jerk reaction, where you would expect consolidation, what prices would be significantly important to you, okay? Where you think the asset might go, because even though it gets volatile, you can predict levels, by using support and resistance levels. Or you can just stay out of the market until the knee-jerk reaction is over. Now, a lot of times there are events that after you practice for a while, you'll see that you can actually see traders taking positions, especially things like the non-farms payroll report. You'll see from 24 hours down to the hour before, you'll see a steady move of gold and the dollar as traders take positions as they believe what's going to happen. Now, the non-farms payroll report is the most important report in the marketplace, but it's a good way to watch how these assets will move. Now, trading news can be very profitable if you can correctly guess which way the price is going to move. Prices can often move 30 to 40 pips very quickly on big news releases, but knowing which way it's going to move is very much a gamble. So traders do not trade the news, as it sometimes is just too risky. Now, if you learn how to build a trading matrix, and somebody just wrote in, how do you determine support and resistance levels? Well, I do a 1-hour class that's just the bare basics of support and resistance. And if you don't understand what support and resistance levels are, you need to go spend some time learning them and come into a class because they are crucially important. And I can't teach you that in this class because here we're talking about learning how to use economic events. You have to learn how to use things like trend lines, support and resistance lines, retracement levels to figure out when, even if you get a very strong positive release, if it's pushing the euro up, how far is it going to push the euro up to? And as it's going up, where will it go down to? How do you determine what the swing of the market is? I can't teach you. That's a strategy you have to develop or strategies you have to learn. But that's many, many hours and days of understanding how you would calculate the swing of the market and where you could put your stop losses. Because most traders that leave the market and blame everything on the broker and say, oh, it's terrible and they're taking my money and they're taking advantage, really don't spend the time learning these things, because a stop loss is the most crucial tool that you can use, because it stops you from losing your shirt in a trade. But not knowing where to put your stop loss properly means that every trade you make, you end up getting stopped out with a loss. And understanding the swing of the market, the price levels, where to put your stop loss, how to move a trailing stop loss up and up as an asset moves so that you're protecting yourself is crucially important. But that's not for this class. Now, in this class, we're going to talk about building a trading matrix. And we're going to real quickly jump up to, I took some screenshots before. There we go, I just passed it. And what I've done is, this is a screenshot of this Friday's economics calendar. And there are, and we're going to jump back and forth, but we're going to do this quickly, between the screenshot and the live economics calendar, because you also have to learn how to read and use and set an economics calendar. And these are basic primer skills. It's not complicated. It's just a matter you have to learn how to use it, how it works. Okay. Now, remember, all data and all releases are rated. There is a universal 3-tier rating system. It's not up to the individual website or the individual releaser to rate the data. All data around the globe is rated, okay, which most people don't realize. Some places, some websites call it impact, some call it importance. It's really called a tier level, but lots of them call it volatility level, because this data is being released by data feeds directly from the releasing agencies to the economics calendar. So the individual website that's hosting the economics calendar only has limited creative things they can do. So they can change little names. Like the economics calendar on investing.com uses bullheads to represent the tier levels for 1, 2, and 3. Where if you're looking at FX Street, they use colors They have three colors. If you're looking at 4X Factory, they use little boxes of colors also. No, I'm sorry, FX Street uses explanation points. 4X Factory uses boxes of color. So they're all the same three-tier rating system. They're all released at the same time. Now, the rating system goes from 1 up to 3. Level 1 data for traders, and remember, this economics data isn't being released for traders. This is statistical data that is calculated and that is researched, calculated, put together, and released for statistical importance. So if you're looking at a level 1 piece of data and it's on the healthcare industry and something to do with wages in the healthcare industry, if you're a job recruiter or you work in the healthcare industry, this report can be crucially important to you. But it doesn't have any effect on the currency or the markets. So there is the three-tier rating system is based on how important it is to the economic cycle of a country and how much effect it has on the currency of that country. Now, it's not in any way reflecting anything else about this report. Okay. Now, three bullheads, 3 tiers, 3rd level is the critically most important data that's being released. 2 is significantly important, but usually is a subset of a higher level report. So like we're looking here in Friday's highlighted report, it's the new home sales from the U.S. It's a very significantly important report, but we also get new home sales increase month over month. That's a 2nd level report of the primary report, which is all new home sales. Because if you ever look at any of these reports that are released, because they're statistical reports, they are huge and long. And they analyze every aspect of every sector involved in everything. This new home sales report would go down from zones to regions to new houses to which size houses, 2 bedrooms, 3 bedrooms, 2 tiers, 2 levels, 1 level, split levels, private homes, attached homes, and then what cities, what counties, everything is statistically broken down. None of that really makes a difference to us as a trader. So we look at what's called the headline result. That's the total number of houses that were sold in the U.S. in the month. New home sales, because we have new home sales, we have existing home sales. Okay, you have building permits, and you have to learn to understand the cycle. Because new home sales are only homes that have actually physically sold. That means they've gone to contract, the sale is actually finished, and the new person takes possession. It's not when, and because this report is all new home sales, it's all based on new construction. So these are not first-time buyers, but first-time owners because the house has not been occupied or by anybody else before. Now, the average cycle from when you actually buy the house till you take delivery of the house in some places is 30 or 60 days. But it's just like if you're buying an apartment and it's new construction, and that apartment house could take 2 years to get finished. So even though it was bought today, it actually isn't sold until it's completed, finished, and the new person takes ownership of it. So you have to understand these numbers. In any of the reports, you have to kind of understand the basics. Okay. Now, we get a lot of this information from the economics counter. Let me pop up the live economics counter on your screen. Okay. So now we're looking at the real live calendar from Friday. Now, if you go down to the line on the event and click on it, it's going to open up a screen that's going to give you all the details so that you can understand it a little better. Because depending on where you are from around the world, these numbers could be staggering. I mean, would you have any idea that the U.S. in the month of January sold 570,000 homes? That's a huge number, especially if you come from Australia, which is a big country, but it only sells about 13,000 homes a month. Because remember, this is new home sales. Because existing home sales are you live in a house and you've decided to move across country, so you sold your house. That's an existing home sale. That's not even incorporated. This is just how many new homes were built and taken possession of. So you need to know and understand what this data is and how crucial it is to the economy and why it's important. Now, the nice thing about this is the economics counter is published way ahead of time, and the forecast or the expectations are released about a week before the data is due to come out, which means that you have ample time to do your research. Most of the time in the markets, you don't have time. You're moving so fast, you miss a trade because you just don't have the time to look it all up. Here, you can sit down on a Saturday and Sunday or in the evenings when you have some time free and the kids are in bed and do your research, get to understand the event. Now, what we can see here is we're expecting 570,000 new home sales. That's against the previous of 536, but the previous is only the data that was released on the report. We're not looking at a comparison between the forecast and the previous, because some months are bad months, some months are good months. Like you can't compare December retail sales, if you're looking at total volume of retail sales, to October retail sales, because it doesn't have any relation, because we know October is one of the best selling months. In new houses, you have to also understand that if the U.S. has a very bad winter time and there's major snowstorms, you may see new home sales drop because people aren't going out and buying, and the ones that are being built are delayed because of bad weather. So the sale will actually start. So you want to look at these more on a quarter basis. But again, the forecast takes into account all of this. So we're expecting 570,000 homes in Friday's report. So what we have to do is, the first thing we have to do is we have to build this trading matrix. We have to decide what number based on this forecast, will be what we consider market neutral. Could be better or worse than was expected, but it's not going to have a significant effect on the assets, especially the dollar in this case. So we do this by going back to this report page, and the first thing we want to do is we want to look at over a yearly basis, where does this number stand, and what is the average report, and is this number going up or down, or is it staying pretty steady? Well, when we look at this report right here, we can see that the number stays somewhere between 540 and maybe it's got as high as 670, but it stays between 540, and the overall average is about 550, 560. Okay. So we're expecting, or the forecast is pretty close to average. If we scroll down and look at the previous 6 reports, we can see that this report is also fairly accurate. When we see the actual against the forecast, we see there isn't a huge variance. We see there's a small variance. Now, the other thing we have to look at is under the previous column, we get what's called revisions. Because all this data is being released so quickly, and that a lot of times the data is adjusted after the previous month is over for that month, because they're going to take in the rest of the reports they get. Say somebody was on vacation for a big housing company and they didn't report a lot of the sales because they were just on vacation. The minute they came back, they finished the report. Well, this could happen, especially on big holiday weekends, big vacation seasons. So when all that data is submitted, that when the new report comes out, they can do a revision to the previous report. So sometimes we can have a revision up or down. And so look, if you're looking at the January 26th report, we can see we were expecting 588,000 jobs, 588,000 home sales. We had a slightly lower than expected number of 536, but we had an upward revision to the prior report. Now, if we put our cursor on the upward revision, it's going to tell us this was revised up from 592 to 598. So technically, they still sold 6,000 more houses, but they were sold in the previous month. If we also look at the previous month, we can see that there was a huge jump, much higher than expected. Now, this often happens in November, December holiday season because a lot of people are pushing to close on their houses before we get into the holiday because they'd like to have the holiday in the new house. So a lot of times these numbers can be skewed, but you have to look at them in the eye of more things than just one. But you will still get this market reaction, but it won't be as violently because if we look at the previous month, we had a huge upswing, and then we also had a revision upward. So the 2 months basically netted out at an average to where it was. So what we'll get was we would get the knee-jerk reaction, and then the markets would go back and do their little bit of analysis, and what we would do is then find a new even level for the dollar. Because basically this was a pretty good report or a pretty good 2-month sector because you see we had 536 and 592. So that's a million, that's at it, 1,000,001, almost 1,000,002, and then we had another 6,000. So you average it out, we ended up with about 1,000,000 or 500. We ended up with about 550,000 jobs, 550,000 houses per month. That's a nice report right here on the line of the average. Now, what we would have gotten we would have gotten this knee-jerk reaction. Now, in order to do this and understand it, we have to build our trading matrix. So let's go back to our PowerPoint, and let me pop it up here. So now so we've looked at the data. We've got a better grasp on where we are and what we've had in the past and what numbers we can be expected. So we looked at the range that the price moved, and we saw it came out pretty close to where it was predicted. So what we have to do is we have to hypothecate or guesstimate. So if I say 570 is the expected, we'll say in a range, if it drops misses by 10,000, 560, an equal range in going up 580 would be market neutral. Okay, follow me? That means we'll get virtually no reaction in the market to the event. The markets would have already, and if you look at the US dollar, probably made some adjustment, or it will probably start making an adjustment tomorrow evening leading into that report on Friday morning. So we're going to put in our market neutral territory. Sorry, let me get my marker back up here. Uh-oh, my screen just changed. Hold on a second. There we go. 5. Oh, I'm sorry. Okay. So market neutral we're going to say is 560 to 580. With 570 being the forecasted number. Now we have to decide between this range and what number would be very negative or cause some volatility in the dollar to go down. So we've already said 560 was minus market neutral. So we're going to say that 550 is going to cause huge volatility downward. Okay. Between 560 and 550, we would get a downward movement, but it wouldn't be as volatile. On the other hand, If we saw 580 to 590, that would be market positive. Okay, and the reason we have to build these ranges, so we would say anything below 540 would be extremely weak, would be very detrimental. Anything above 600 would create huge market volatility. The reason we're doing this is we also have to be able to take into account the revisions. And the revisions can't be done in a mathematical calculation. We can't, once we build our market neutral, market positive, market negative, we can only build that on the forecasted event. So we have to say if there's a revision upward, a positive revision, it's going to cause a bump. If it's a revision downward, it's going to cause a bump also. One would push it, bump it down, one would bump it up. So if we came out in, say, 560 or say 555 in this range here, which would be a market negative event, but we had a previous upward revision, it could bump this back into market neutral. Whereas if it came into this range here, and then we get a downward market revision, it could bump it down into this weaker range because there's no number we can assign to this. It's just where will it push the trader sentiment. So if we were all the way down here at 540 and we got a big upward revision, it could push the traders up to where it's just into a slightly weak report, just like I showed you when you took the 2 months and averaged it out. Okay. But there's no way you're going to get the knee-jerk reaction, and there's no way to know exactly how strong it's going to be. So you have to be able to figure out how weak or strong it's going to move the asset. Then from here, we have to go look at a second set of data, which also causes bumps, because you can't analyze two different reports by building your market neutral range. So we also see that new home sales month over month is coming out. That's a level 2 data. It's part of this larger report, but this headline report is ultimately important also. So we see in the previous month, we had a drop of minus 10% in the month's sales for that month. We're expecting an increase for this month of a climb of 6.3% of new home sales for the month of January. So this is just on the monthly basis. So we're going to go back over to this report again, and the economics calendar event, and let me pop it up on your screen here. And we're going to go click on this line again. As the new home sales measures the change in percentage of the new home sales. A new home sale is considered to be any deposit or contract signing either in the year the house was built or the year after it was built. A strong number would indicate a strong housing activity and therefore a strong economy. A higher than expected number should be taken as positive to the US dollar. Now, we can see that these monthly sales, we only want to see, is all over the place. Now, we can expect, or we analyze it, we would have expected new home sales in October to be stronger because, again, people buy or close as far before the holidays as you can. Now, remember, the U.S. goes into Thanksgiving holidays before Christmas holidays. So people would want to push to close the deals early or sometime in October so that they can move before the Thanksgiving holiday. Okay, and in November they're going to push to close so they're in before the Christmas holiday season. So we see October was up because a lot of people probably got in faster. Just like when you buy an apartment in a condominium building and you're buying in like I have some investment condominiums in Florida. Now, when they built the building, they finished it and they get their certificates of occupancy for all the building almost virtually the same day. So they have 300 apartments in there they have to close on. So the escrow agents can only close on so many. Okay. You have to, because all of this has been done, the paperwork's been done, but they still have to process everything. So what happens is, if if you bought a home and it's down the holiday season, you're pushing that escrow agent to move faster so you can get in for your closing. Or if it's not holiday season, you say, okay, well, schedule me for next Friday or a week and a half from Friday, and I'll come in and we'll do the paperwork. Now, because you want to move as fast as possible, so you want to get close, so you can schedule the movers, get in your new house, things happen faster. So you have to understand how all this takes into account. Now, last month we had a very weak, very weak number. It dropped 10.4%, but our new housing sales were also fine. But again, that covered January sales. January is a it was December sales. December is ultimately a weak month because people aren't really buying homes. They're Christmas shopping. They're on holiday. They're on vacation. So January should be a good month. So we're expecting that number to be 6.3% this month. So we now have to decide in our matrix where that number would fall. So let's go back over to my PowerPoint. So again, this can only be a bump. So we have to look at this and say, okay, this number can be fairly acceptable. We have to figure out where our market neutral range would be, and then where our market positive range would be. And then when it comes in, bump that and accordingly onto our market positive and market negative. We don't lay out a new one of these. We use the same one, but we add this as a bump into those other determinations, because you could have a weak report but a good upward revision and a good new home sales for the month, and that could push it all back into a market neutral, or it could push it all the way over to a market positive territory. But there are ways to analyze these reports. Once you've analyzed them and you determine what number is going to be enough to push the dollar up or down that you get in reaction, you then have to determine where you would expect or how far you can expect that reaction to go, where you would consider entering the marketplace, where you would put your stop loss, and where you'd take profit. Or you can use a completely different strategy ahead of time and just buy into the results ahead of time based on market movement ahead of time. You could take a position ahead of time to get out after the market volatility is over. I've got one last question, and I'm going to run because our class time is over. Somebody asked, why do some events have no forecast? Okay, let's go back over to the report and the economics calendar. Okay, and let's use some common sense. First of all, there's lots of reports that have no forecast because there's nothing you can forecast. A speech, a central bank meeting, a testimony by Janet Yellen have no forecast because nobody can forecast that in numbers. Other agencies, like the Hughes-Baker report countdown here, has no forecast. It's just a calculation of how many oil rigs were shut down or turned on that week. There's nobody that can forecast. It's small little numbers, 597 the previous. So nobody's forecasting it. There's nobody going out for forecasting. In consumer inflation on the top, you have your core CPI for the month below. That's a three-part report there, and it encompasses the upper one, which is just accumulation of the previous months. Okay. So a lot of times the reports are insignificant enough that nobody's doing a forecast. Okay. Or they're parts of a larger report where it's just a small thing. So when you look at core inflation year after year for January, it is simply a accumulation of the month-over-month reports. So there's nothing to forecast. It's just a simple accumulation. So you have your consumer price inflation for the month of January out of Canada. Here expected at 0.3, and we're expecting core CPI. Core takes out big ticket items like airplanes, boats, trucks, transportation items, so you can see the real consumer effect. And here we're expecting a drop of 0.1, and this is just our cumulative. And then we also only get them so close to an event. So like next week's aren't even out yet. Next week's will start as they come out, as they're projected, they'll start coming out. But these are from forecasting agencies as opposed to the releasing agencies, because the releasing agencies do not usually forecast anything at all, because then they would be using the data to forecast. So sometimes you read in Bloomberg or Reuters. Sometimes Reuters will say our 26 in-house analysts project this report to be at. You'll see where, and they're almost all exactly the same. And the forecasts are usually so accurate, that's why the markets take them and accept them, because you got to have some type of expectation. So like you see on here, this is this week's report so far. So our initial report, our inflation report hearings out of the UK was testimony. There is no report. Okay, somebody asked, and then I'm going to go. One can apply the same concept to a pre-report of an equity estimate earning. Nope. A stock or a equity report is it's just like it's an entire country to itself. There are so many other parts to that wheel that you have to know exactly what you're talking about. Like if you looked at today's report or yesterday's earnings report from Walmart, Walmart's earnings were missed expectations, except their online sales and their their forward-looking guidance on online sales was spectacular, and they also issued a dividend. So what happened was their stock went way up. Okay, it's a whole different type of analysis that's done there, and if you want to learn it, you can come to our class on quantitative analysis for the stock market, but there are lots of pieces of information that go into that puzzle. So on that note, I'm going to say goodnight to all of you. Thank you very much for joining us, and have a great trading week. Bye now.